Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings so you don't have to. Today we're diving into an 8K report, and let me tell you, it's about as exciting as watching paint dry. But fear not, we'll try to make it interesting and see what skeletons, if any, are hiding in Xperi's closet. So Xperi Inc. filed this report. An 8K report basically means that something important happened that the company needs to tell the public about. Think of it as corporate show and tell. This particular report is dated February 21, 2025, which, as you can see, is in the future. So let's check it out anyway. The main event here is that Xperi entered into something called a receivables financing agreement, which is basically a fancy way of saying they're borrowing money using their expected future payments as collateral. They're doing this through a deal with PNC Bank and a newly created subsidiary, which is like a mini company they own specifically for this purpose. This mini company is called Xperi SBV LLC. The important thing here is that this SBV is set up as a way for Xperi to get cash now based on money they expect to receive later. To make this all work, Xperi also signed a sale and contribution agreement. Think of it as the instruction manual for how Xperi will sell its future payments to this mini company, Xperi SBV, who then uses those payments to secure the loan from PNC. Several of Xperi's subsidiary companies that generate these payments are also involved. Together, these agreements create what they call a securitization program. In plain English, it's a way to package up their expected payments or receivables and sell them to investors, in this case PNC Bank, to get cash up front. Basically, some of Xperi's subsidiary companies will transfer their rights to receive future payments from their customers to the newly created company, Xperi SBV. Then Xperi SBV will borrow money from PNC Bank, using those future payments as collateral. The most they can borrow through this setup is $55 million. This amount depends on how good or eligible those future payments are deemed to be. Xperi is guaranteeing that these payments will come through. This means that if, for some reason, the companies involved don't fulfill their obligations, Xperi itself will be on the hook. Even though Xperi SBV is a separate entity, Xperi will still include its financial information in its own reports. This means we'll still be able to see how this arrangement is impacting Xperi's overall financial picture. Of course, all of this comes with fees. Xperi SBV will be paying structuring fees, closing fees, and recurring annual administration fees to PNC for setting up and managing this whole operation. The interest they'll pay on the borrowed money is based on something called the term SOFR rate, which is a benchmark interest rate. It's a bit complicated, but essentially it means the cost of borrowing can fluctuate. The agreements are pretty standard for these kinds of deals. They include the usual fees, requirements, promises, and guarantees that you'd expect. There are also rules and limits on which payments can be used in this arrangement. Some payments might not qualify, and Xperi needs to keep certain amounts in reserve. If things go wrong, like if Xperi misses payments or violates the agreement, PNC can demand the money back immediately. This is a standard clause to protect the lender. This financing arrangement is scheduled to end in February 2028 unless they decide to end it sooner, so it's for about 3 years. Since this whole deal involves borrowing money, it creates a direct financial obligation for Xperi. This is just a fancy way of saying they now owe money. Now, let's step back and try to understand what this all means for Xperi. On the one hand, this securitization program gives them immediate access to cash that they can use for operations, investments, or paying down other debts. It's like taking out a loan against your future paychecks. However, it also means they're taking on more debt and committing future revenue. If their business slows down, they might struggle to make those payments, and that could trigger problems with PNC. From what is publicly known, Xperi operates in a competitive technology market. They're selling things like licensing their technology and product. This puts them in a position where they have to constantly innovate and maintain their market position. This securitization gives them more resources to do so. One of the notable risks is their ability to continue generating receivables, which can then be turned into cash. Any downturn of their industry might impact that ability, and therefore it could be an issue. Based on available information, estimating a price for Xperi stock is difficult without deep knowledge of their future revenue, but let's assume that they can continue doing well in the coming years. If that is the case, a reasonable price range could be $12 to $15. Overall, with some risk, Xperi's move is cautiously bullish. It gives them flexibility in the short term, but it also creates potential problems if revenue is down in the coming years. Thanks for watching. If you found this helpful, please subscribe for more corporate deep dives and please share this video with any friends you think might benefit from it.